Hello and welcome to our presentation today. We will get started in just a few minutes.
Hi, everyone. Thank you so much for joining us today. We're really excited about today's webinar. It is our very first partnership webinar. 1031 specialists and source advisors have partnered together to better service our real estate clients and CPAs who specialize in real estate. So super excited to hear the content today. For those of you who might be new to source advisors, we've been helping CPA firms and businesses maximize federal and state tax incentives for over 40 years. We're headquartered in Fort Worth, Texas, but we work and are located throughout the country. We specialize in R&D tax credits, cost segregation, LIFO, energy efficiency incentives, as well as certifications, sales and use tax, and property consulting. My name is Jennifer Flynn. I head up partnerships here at Source, and joining us and presenting today are Rudy Krupka from 1031 Specialists. We have Gail from Source, and he's our technical sales director. And then we have Marty, who is our tax manager, and he's going to be going over the interplay between 1031s and cost segregation studies. So thank you so much for joining us, and I'm going to turn it over to Anne, my colleague, so she can go through some housekeepings.
Thank you, Jen. There will be 4 polling questions during today's session. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features, which are located in the upper right corner of your screen. If you have a question specifically for our presenters, be sure to use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. And lastly, a PDF of today's presentation is available for download now under handouts, should you wish to follow along or reference it afterwards. And with that, I will hand it over to Rudy.
Anne, thank you very much. I appreciate it. And Jen, thank you for the introduction as well. Look forward to spending a few minutes with everyone. I'm going to put together here a very high level of the 1031 exchange process, and specifically focused for our CPA referral partners and CPA firms. As Anne and Jen mentioned, my name is Rudy Krupka. I'm the Vice President of Strategic Partnerships for 1031 Specialists. Please feel free to scan the code for my contact information. We are a 1031 exchange agent, also known as a qualified intermediary, and we do have a 50-state footprint. Our headquarters is based in Denver, Colorado, and our operations and business development people run the gamut from Carolina to California. Here's a real high-level overview of what we're going to present today, why 1031 exchanges matter to your practice. A basic overview, very high level of a 1031. Why should your clients do a 1031 exchange? How do the numbers work? What can I exchange into? Do I qualify for a 1031? And what I like to refer to as the 6 commandments of a 1031 exchange. And then at the end of our presentation, we'll have opportunity for more questions. So why does a 1031 exchange matter to your practice? You may be surprised by these numbers, but 85% of all eligible clients to do a 1031 exchange never hear about it until it's too late. And as you know, a 1031 must be set up well before the sale closes, and you, the CPA, as a trusted advisor, is oftentimes the first person to know. Our statistics, show that only 1 out of 7 properties that are eligible for a 1031 do a 1031. And we look at that as an opportunity to continue to educate and work in the community to teach people what a 1031 exchange is all about. So how does it deepen a client relationship with your CPA firm? I think these are all going to be very much common sense. A 1031 turns into a one-time return into a multiple year planning relationship because you're close to your client in terms of discussing reinvestment, depreciation, and hopefully the next exchange. And spotting a tax deferral opportunity positions you as a very proactive advisor who at the end of the day saves the client real money. Clients who defer 6-7-figure gains remember who made it happen and hopefully refer you to others. And we handle really the entire process from cradle to grave as the qualified intermediary. No one expects the CPA to be a 1031 exchange expert, and that's what we're here for. Looks like we're at our first polling question, so I'm going to hand it over to Ann real quickly.
Thank you very much. Yes, this is our first of 4. How often does a client ask you about how a 1031 exchange works? A is often, B is occasionally, and C is never. If you're having trouble answering the question, please make sure your brightness is all the way up. There is a button to adjacent to the question to answer. And at this point, the majority of our audience says B, occasionally, followed by often, and then with just 8 people reporting never.
Okay. There's an opportunity.
Yes. We're all set.
Yeah, let's go through really what a basic overview of a 1031 exchange entails. If anyone catches me in the elevator and asks me what it is, I simply say it's the sale of one investment property and the purchase of another without paying capital gains on the profits. It's honestly that simple. There's 2 key differences in facilitating a 1031 exchange in a real estate transaction. For all intents and purposes, it's a regular closing, but 2 things must happen. Number 1, clients must hire a qualified intermediary at the very beginning to facilitate the 1031 exchange. And number 2, sale proceeds can never touch the client's bank account. That includes the title company. And I'll tell you a short story that on a weekly basis, we get a telephone call that goes something like this. Rudy, I just completed a 1031 exchange. The title company, Rudy, I just completed a closing and the title company is holding my money. At that point in time, it would be too late because the individual took constructive receipt of the funds. There are 3 types of exchanges. Honestly, we probably see 90-95% as a forward exchange. And that simply means that the investor sells first and then replaces the property within 180 days. Once in a blue moon, we do a reverse exchange, and that means that the investor buys their replacement property first and then sells the relinquished property, which still must happen within 180 days. And very seldom do we have an improvement exchange where the exchange equity goes into repairs and improvements or construction on the new replacement property. The issue with most improvement exchanges is that the improvements still must be done within 180 days, and that makes it a little bit more difficult. Why should your clients do a 1031 exchange? Now, I am certainly not a tax expert, and I don't know all the rules in every state, but what we see from a national basis is that when someone sells an investment property, there can be as many as 4 layers of tax. Number 1, capital gains tax can vary between 15 to 20%. Your state income tax varies. If you live in beautiful California, it can go up to 13.3. Net investment income if it's applicable, and then of course you have depreciation recapture. So those 4 layers can add up nearly 40% or more of clients' gains, and a 1031 exchange defers every one of those layers. And as you notice here, I say defer because it doesn't mean it eliminates them forever, right? And I think you guys know that. Very simple example I share with people. If I close a $2 million property without a 1031, Uncle Sam's going to get $800,000 of my money. And I don't want that to happen because I can invest that $800,000 again into the next investment property. So how do the numbers work? Very simple example. 2 things that you need to do to defer 100% of your capital gains on investment property. 1, you must purchase a property of equal or greater value than the net selling price of the relinquished property. And 2, you have to reinvest all the cash. Now, there are people that can do a partial deferral, and I'll talk about that here shortly. Very simple example, sales price $1 million minus allowable closing costs. Your net sales price is $950. $950 is the magic number that needs to be in the replacement property. And if you have debt on the property, a mortgage, a loan, it works just like this. You still have to replace the full $950, and the $500 mortgage can be replaced with another mortgage or cash. But at the end of the day, your net still has to be replaced of $950. So what if someone wants to buy a replacement property that's less expensive than the net selling price of the relinquished property? And this happens all the time. In fact, I just had a couple in Florida. They sold a $5.3 million property. They're replacing it with a 4.5, and they're simply taking the difference to pay for their grandkids' education and paying taxes. As you probably know, in our world, taking cash out of a 1031, we call that boot. Okay, what can I exchange? This is a question I get all the time. We refer to properties as like kind, but it doesn't mean that it's the exact same property. Any US-based real estate qualifies for a 1031 as long as it's been held for business or investment purposes. Obviously, your primary home and your vacation home wouldn't qualify, but anything that is a residential investment property or a commercial investment property would qualify for a 1031 exchange. This is a great example of how often people are taking a particular investment property and exchanging it for a completely different channel. And I see this a lot when it comes to farming, ranch, raw land, where they sell and acquire an apartment or a duplex or industrial property. So you never have to exchange one for one. You can go into completely different channels. All right. What are some of the conversations you should be having with your customers, and why are some of the what are some of the reasons and opportunities to do an exchange? Consolidation into fewer properties. We do see that quite a bit. Diversification into multiple properties. This year, we had a gentleman sell an industrial property and turned it into 49 single-family rentals. That has to be the strangest transaction we've ever done, but he happened to buy a portfolio from a builder, so it was almost like doing one deal. Elimination or creation of joint ownership. This happens a lot. We call this a drop and swap. And that means that for whatever reason, partners do not want to continue, and they facilitate dropping individuals. This month, I had 7 investors in Connecticut. 2 wanted to move into a new 1031 exchange. 5 wanted to leave and take the money and then obviously be taxed on it. And there's some complexities of a drop and swap that I won't go into here. The opportunity to depreciate on a higher basis replacement property, relocation of investment property or business. I see this a lot these days with people moving out of New York and moving to other states. And then this is the other thing that we see, probably 15% of our transactions, that they're moving away from active property management and into passive investments like a DST, a Delaware Statutory Trust. Okay, $1 million question, do I qualify? And this is super simple. There's really 3 things I always ask. Are you a flipper or a developer? You would not qualify. Is the real estate owned in the United States for business or investment purposes? And when did you buy it? The when did you buy it is tricky because there's no IRS statutes anywhere to be found that says you must hold a property for 1 year, 2 years, or more. IRS works off of a concept called intent. What is your intent with that property? Is it to be held for investment purposes? I love this section because this is just a highlight of what we call the 6 commandments. Number 1, the property must be held for business or investment purposes. Number 2, if you'd like to defer all the taxes, you must purchase a property of equal or greater value than the net selling price of the relinquished property. Number 3, you must identify your replacement properties within 45 days. And the identification process is something that we handle. It is literally filling out a form, submitting it to our exchange officer before day 45. There is a way that you can identify more than 3 properties, but there are additional rules that apply if you do. And you can't change this. You can't come back on day 50 and say, I changed my mind. This is crucial in any successful 1031 exchange. You must sell and buy as the same taxpayer. The name or entity on the sale must match the name and entity on the purchase. And this is a challenge that we have oftentimes when people want to change an LLC. Just as a small reminder, a single member LLC is really treated as a single owner, and the LLC is disqualified. You've probably heard the 180-day rule. It's hard, fast. There are no exceptions to it. You have to complete both sides of an exchange within 180 days. And the way it works is the clock starts ticking the minute you close. We call that day 0, and that's the sale of the relinquished property. By day 45, you've identified 3 or more properties. And between day 45 and day 180, you must complete the purchase. If any of that fails, unfortunately, the 1031 exchange is disqualified and you get your money back. As a matter of fact, why don't I just highlight something real quick? If for whatever reason a customer cannot identify within 45 days, they get their money back on day 46. And if they've identified and for whatever reason they can't close on a property, they get their money back on day 180. And as a small side note, we're the only national QI that also will refund all of their service fees. We don't believe in keeping a service fee if a exchange doesn't happen. And last but not least, you have to use a qualified intermediary like 1031 specialists. So I know we have a question and answer opportunity. And would you like to do this at the end, or do you want to do this a little bit now?
I think we can do this one now. Vincent asks, will you go over a PIN exchange or PIN exchange?
Well, Vincent then caught me off guard because I do not know what PIN stands for.
Does somebody else on our panel happen to know what that is? All right. Well, Vincent, if you can put in the chat a little bit more information, we will get back to you.
I do see Joe's question, if I could answer that, if you need to recapture depreciation on vines and farmland when completing a 1031 exchange. And Joe, I think that's a perfect example of where I always share with people that as a qualified intermediary and the exchange agent, we do not provide any advice that is financial, accounting, or legal. And in something like this would happen, and that question is posed by an exchanger, I would always ask them to go back to their CPA. That is something that I wouldn't have knowledge of as a non-CPA person.
Well, great. At this time, there are no more questions for you, but I think you'll stick around to the end in case we have anything else.
Absolutely. Thank you, everyone.
Great. And John, it's over to you.
Great. Awesome job, Rudy. That's my first time getting to hear Rudy talk through those slides as well. That's makes that really easy to understand. I enjoyed that. So now we're going to move right into cost segregation. And some of you might be more familiar with this. It's a little more it's been around a little longer, more people have touched it, but if you haven't, this should give you a good overview. I won't read right off that slide, but I will give you a little bit more background. I was in Beta Alpha Psi college. Usually when I'm in the room, I'd look around and say, hey, look, somebody else there. With 130 you guys, I'm sure someone else did the Beta Alpha Psi thing. But I am the head of the education committee and a board member of the American Society of Cost Segregation Professionals. So I do encourage you guys to look for quality providers, somebody that's part of that organization. So let's go ahead and jump right into it because I don't think I have as much time as I normally get. Just a couple quick bullet points we're going to hit. What cost segregation is, why it matters to you and your client, how we qualify property, and when you engage us and can expect a study back. So let's talk about it. What is cost segregation? Well, the best way I think to conceptualize that is consider what you buy when you bought any given real estate, right? You didn't just buy land and building, although that is what ends up on our depreciation schedules a lot, right? But you also bought land improvements, you bought asphalt, sidewalk, lighting. Inside you might have bought cabinetry and decorative lighting, floor coverings, these types of things that we can move into a shorter life, that 5, 7, 15-year class. And 100% bonus makes that even more important. But why do we want to do that? Well, we write it off soon. this year, next year, over the next 5, with 100% bonus. Most of that's going to be eligible for 100%, like I said. And we're going to move more cash flow to the front end of our depreciation schedule, right? That way our owner can put it back in the next business prop that they have working, or go to Tahiti, or, whatever their goals are, they achieve them a little sooner. Now, and one thing I like to slip in there, if you have very old clients that are planning into life stuff, this is definitely a good time to get involved in cost segregation if you're not already. And we can talk through more of that, but that's a little beyond the scope of this presentation. So let's look at what we look at as cost segregation preparers. These are the 3 here on the left, this owner, general contractor, change order. These are the 3 buckets that really flow into any given new construction project, right? Your costs are going to come from one of those 3 things. And then once we get that, and sometimes your general contractor will break those out into these first 16 construction divisions. If not, we identify that further. But the real meat and potatoes comes into this sort units of property. That's where we're estimating how much landscaping, how much parking lot grading you have, your storm drainage, what types of floor coverings you have, and how much cabinetry or even electrical power that's running to like equipment if you have a manufacturing or a data center facility. And that's where we're estimating the total amount of those. We're doing takeoffs and a real site visit. Don't have a cost seg done that doesn't do a site visit. But, and then we're putting real values to those using things like RS Means and Marshall and Swift construction industry cost databases. And then we're assigning them to those tax lives, right? With the ones you guys being most interested in, 15, 5, and 7. So who does this apply to? We like to say, generally these work for the last 5 to 7 years, but as my tax teacher always told me, it depends, right? Everything in tax depends. If you've got a $40 million property and it's 15 years old, there might still be an opportunity there. You have enough basis that a reclass, you've written off a lot, but you haven't written off so much that there might not still be ROI for you. That being said, if you just have an Airbnb, those will go down to 250,000. I know you see on my slide 500,000, but for Airbnbs, we can usually make the ROI make sense at about 250,000. But again, if that's 5, 7 years old, it's probably not going to. When we do estimates, they're always free. We like to give you guys, a good understanding of exactly how much we think we're going to be able to accelerate, so you can advise your clients correctly and help build that trust instead of erode it. Anything that you buy, build, expand, remodel, cost segregation can be a great opportunity for those. You do have to be a tax-paying entity. It doesn't actually matter if you are a taxpayer. If you own a property in another country, we can still work with that as long as you're paying U.S. taxes on that revenue, right? So, and more complex buildings, that's what's really going to drive it. A warehouse with 4 walls and some overhead lighting and a gravel parking lot is going to drive less than that, high-end R&D style manufacturing place where they're making chips, right? But they both usually have a return on investment that makes sense for our clients. And when they don't, we advise you on that. So let's talk about when we use this thing. Everyone knows when we buy it or when we build it, that's the most common time to really bring in a cost segregation professional to do a study. But that goes even further. We should really think about it as something that's useful for the whole life cycle. Even if it's, on that number 1 there, even if it was something you bought 5 to 7 years ago, we can still go back and try to capture that depreciation by way of a look back study. But of course, if you're planning repairs in the future, or dispositions, let's talk about that. On the front end's best, obviously, so we can plan accordingly and make sure that everything gets set up for you the right way. But if not, we can come in on the back end and do these things too. Identify those repairs and the dispositions, those things that you're going to be able to write off when you do that remodel, right? So those would fall under our TPR study, which we offer full support for that. But over to Rudy's point, when you structure that 1031 exchange, this is going to give you a really good idea of where your assets are. You're going to know exactly how much, 5 years left or 15 years left, or, how much deferred gain you're really talking about. And so whether or not a 1031 makes sense, or even how to get to that exchange excess basis is going to be set up perfectly for you when you have a cost segregation on the front end. Looks like that's polling question number 2, Ann.
Thank you. Again, this is 2 of 4. What is the primary purpose of a cost segregation study? A is determine fair market value. B is identify assets eligible for shorter depreciation lives. C, calculate property taxes. And D, determine replacement costs. This is the 2nd of 4. You do need to respond to 3 of 4. and attend for 50 minutes in order to be eligible for CPE. And it seems like the vast majority say B, identify assets eligible for shorter depreciation.
Sounds good.
We're all set.
All right, guys. So let's talk about that financial impact. This is that thing your client cares about, right? More money in our pocket today so we can write it off faster, right? $1 a day is worth more than $1 tomorrow. That's the bread and butter of what I do. Put that cash flow back in your pocket. You can fund your business growth. You can maybe build that additional building that they need for equipment or whatever it might be, or take off and go toward Europe. Or everybody has goals, right? But the point is, put that money back in your client's pocket today, so that they can fund those goals now. And then if plans change down the future, we have deep expertise to help you guys navigate that as well. This is crazy. I saw this right before. So marketing got a hold of my slides, guys, and they made them look all pretty. Normally this slide has like call outs and everything, and it's a little more cartoony, and everything on it's misspelled, but you can kind of tell that that's asphalt paving and that's decorative lighting. And I think that stuff's fun, because if I'm boring you, at least you have something more fun than that to focus on. But you guys must be my most important audience that I've had yet. So you get the clean one. But the information's the same. The things we're looking for, it's that parking lot, the retention pond, decorative lighting. If you have high-end floor covering, something like snap lock or floating floor, that's going to drive a higher benefit than if you have the cheap vinyl or sheet, or there's just so many building materials out there. So the specifics of what your building has in it is what is going to really drive that benefit to you. And of course, qualified improvement property. I don't think I have this polling question in there anymore, but there are improvements to the interior portion of a non-residential building after it's placed in service, right? So I don't think anyone's gonna get it wrong, because I don't think I have it in there today, but most of us know that one. Now I will say, don't if your client does an interior renovation, don't throw it all into QIP. We can talk about that. I might still have that slide coming up, but like I said, I get less time today. But reach out to me offline if that's a conversation you want to have. This is the potential reclass we tend to see on properties. As you see at the top here, warehouse tends to be the least complex, has the least finishes, so it's going to drive a lower total reclass percentage. Now, a lot of times they have a huge, like a distribution facility. They might have 20 acres of concrete paving outside, and so that's obviously going to be a much more favorable reclass. And then down on the bottom, we see data center, manufacturing, R&D. These things are going to be really complex. They're highly unique. They're going to drive a lot more benefit than, say, a warehouse or even a motel, right? And of course, when we get into tenant improvements are king. That's where we really start talking about, we're getting into QIP. And if it's manufacturing these days, and now we're getting into talking about qualified production property. So that's that. Some of the things that affect it less, if it's a brand new building being built versus an acquisition. With an acquisition, we have obsolescence going on. Your road's deteriorating at a different rate than your carpet is deteriorating at a different rate than your sinks, and so that those factors affect it. Obviously, also we have when we do construction, these contractors don't always capture every cost perfectly, and so that influence can drive it a little bit. But let's see. I knew we had one on here still. Great, this one's still in here. So let's talk a little bit about qualified improvement property. The IRS wants us to identify all the property, not just the qualified improvement property. And let's think about why. First, from a taxpayer's perspective, not every state is coupling with the federal definition. We don't get this 15-year 100% bonus in every state. So when that happens, we also want to look at the 1245 property, so we can move that property for our clients as well. But not only that, let's say that we put this $4 million renovation and we put it all into QIP and we wrote it off. And then our owner got a deal he couldn't refuse. He sells the building 2 years later, and then it comes under audit. Well, now we can't get access to the building to prove what was there, and we really end up at the IRS agents. What he or she determines is the right amount of 1245 in that property. And we're not gonna be able to fight it because we can't access it, we can't document it, can't take notes, can't take measurements. And that 1245 has a much worse recapture rule, right? So if you like to cross your T's and dot your I's, then this is obviously the best way to go. But also we see it go the other way where people say, well, we're doing an enlargement, so that doesn't qualify for QIP. And we have to be careful when we talk about that definition, just because, if you're building another 20 by 20 square foot section onto the edge of your building, yeah, that's a true enlargement. But if you have a 30-foot tall warehouse and you're putting a mezzanine in the middle to construct the second floor, that second floor might be considered structural and might not qualify for QIP. But the other improvements inside that space probably will, because you haven't actually increased the cubic volume. Even though you've increased the square footage by adding a floor, we didn't really create an enlargement because there's no cubic volume change. Oh my gosh, I never even knew what this guy said. That's awesome. Man, you guys are important. So this was actually my favorite slide. Now it's a normal guy. So some people think this is only for large businesses. That's absolutely not true. Like I said, we work with the Airbnb, the guy who just bought his first Airbnb, and of course we do airports and aquariums, and we do skyscrapers in Manhattan. We do skyscrapers in London, for that matter. So we have there is deep expertise to cover any building that's income producing. We're here for you. And some people then think stuff's too expensive. There are cases where we don't expect to achieve that ROI of 10 to 1. And when that happens, we show you up front, the estimate's free. And we're very transparent about that, because we'd rather build, partners for the long term rather than the short term. This is an industry where you live and die by your reputation, and we intend to keep a good one. So when it's below 10 to 1, sometimes our clients still want it because they're desperate for deductions. People have all kinds of reasons, but we try to show you where we think your ROI is actually likely to land, with the mantra of under promise, over deliver. And people say this stuff's risky. You guys are lucky. I no longer have the history of cost segregation since 1942 in here, but it is backed by tax law. And when you have a quality study done, your audit risk is minimal. So let's talk a little bit about the tests. I even shortened this one down for you. This one comes from this interstate commerce facility where basically they had trucks backing up, and they were unloading stuff on the dock and then moving the stuff into the building. And so the taxpayer argued, well, this doesn't look like a building. It doesn't have walls, doesn't have doors, doesn't have windows. And the IRS decided, well, we're going to focus more on the function part of that test and say, well, it's providing workspace that's more than incidental to the function of that building. And so we get a tax court case here. And basically the tax court in this case decided to side with the IRS, and in that, if it provides workspace more than incidental, then we have to qualify it as a building. But that being said, you see the structure, not every structure that looks like this is going to be a 39-year structure. Sometimes they're 15. I could even see them being other asset class lives, just depending on the facts and circumstances, right? It depends. But these are the types of things where you really want a qualified study and not just take that guess. You're going to get the question on the audit, which we got last year. There's this really contested case out there, and basically they came back and said, hey, did you guys consider this case? And we said, yes, we did, and that was the end of the audit, because they were just going after low-hanging fruit and low-quality providers that couldn't answer, what tax law and what case, what industry standards and history has what's the word I'm looking for? Precedents have led to you feeling you have substantial authority to make this decision, right? Just another reason to have a quality provider. So let's talk a little bit about accessorial tests. This one's really big, and I won't read these to you, but let's think about what it means to be accessorial to a business. The example I like to use is an elevator, right? An elevator, it really can't function without that motor, right? And so that motor is a separate, or is they're basically, the elevator and the motor become one unit of property. We can't separate those out because the building needs an elevator to function normally, and the elevator can't function without the motor. Now we go out into your warehouse or your distribution center, and we look at the overhead doors out there, and all of them have a motor on them. Now, that motor, I'll qualify in that case as a 5-year property, and that's because it, in most cases, those overhead doors can function by a chain pull. We can lift it and lower it with a chain if that motor breaks or if we take it off, and that means that since it can function independently, now it can be considered a separate unit of property, and we can make a good case for accessorial, non-permanent type testing, right? Just a lot of facts and a lot of history that goes into these types of determinations. We talk about sole justification. This is one of my favorite slides because I draw on it. This really only applies to HVAC. I've seen people make arguments for it the other way. We don't have any substantial case law saying we can use it beyond HVAC. But so basically, this what you're looking at here, this white box at the bottom, you're in a big box store like a Belo or a Sam's Club or a Costco or something like that, right? And it's one of those big coolers that you walk around. It's a bunch of frozen food in there. So those little circular fans you see on the top are moisture extraction fans. They pull all that extra moisture out of the air so that customers don't slip when they're walking around here, right? So that's clearly only going to operate for a grocer. If you move this out and Amazon moves in here, unless they have a cold storage section, they're not going to need those. So that would be accessorial. We can use sole justification test. That one's kind of a slam dunk. We can attack that one a couple different ways. I leave this one on here. It's exactly how it's written in the decision. It is a little bit repetitive the way it's worded. That's why I don't change it, because we've seen cases where when this went to court, the IRS chose to focus on 1 and 3, and there's other cases that were decided more focused on 2 and 4. And so again, just because we can make this test doesn't necessarily mean that it qualifies. We really just have to know the history and the case law and the precedents that have been set. So let's talk about what it takes to get one of these things done. Right, 9/15 is right around the corner, so we are basically out of time for that. But really, what we look at, that first week, we're getting a proposal from you guys. We're starting to ask for additional data. We're looking at it. We're scoping that thing, trying to figure out if we're going to need additional stuff, additional files and documents from you to get it done. And then we're reviewing all your data before we get out there. We're assigning our engineer, maybe starting estimates if you have drawings or something else that's quantifiable. And then by week 3 to 5, we're doing our site visits. We say 3 to 5. I've seen people get out there the next day when it's, when we're able and when we really have to, hustle or any number of reasons, right? We hustle for our clients. We all do that. But 3 to 5 weeks tends to be the sweet spot, especially if there's airfare or anything involved. But again, we have engineers all over the country. That's one of our advantages of being so large, that we usually can cut down on those costs just by we have someone probably in your region. Weeks 4 to 5, we're compiling the report. It's going through 3 levels of reviews, including a peer review, senior management / tax review. A heavy tax person comes in, and then we have a quality control reviewer on the back end as well. We deliver that to you and your client. That'll either come to you or your client or both, depending on how you want to set up that relationship. We really, we work around you and what you guys want. And if there's something that needs to be changed, you send it back to us within a reasonable time. We get that done. Week 6 to 8, we have it back for you. Polling question 3, Ann.
All right. Is land depreciable for federal income tax purposes? A is yes and B is no. Is land depreciable for federal income tax purposes? Somebody's got to reply. This is our third of 4. They're rolling in now. B says no. The majority say no. What do you say, John?
The no is probably right. And what was the question one more time?
Is land depreciable for federal income tax purposes?
No, it's not. No, it's not. And I actually did fight with the CPA on this one time. An auditor was convinced that land should be depreciable, and that's a weird conversation at 8 a.m. because you don't know if someone's messing with you or not. But no is correct.
Well, the vast majority agree with you, and we are all set to move forward.
Wonderful. Martyn, that's going to be you.
Thanks, Sean. My name is Martyn Voorhis. I'm a tax manager here at Source Advisors. If you think back to a couple slides ago when John just said that all of our studies undergo a tax review at the end of the process, that's my job. I also work a lot on the front side with the sales team and talking with CPAs and clients that are doing 1031s and just making sure on the front end that they have a viable enough basis to warrant a cost segregation being done. So I was going to talk a little bit about the interplay between cost segregation and 1031. The biggest thing to keep in mind is that when you have a 1031, you are left with two buckets of basis. You have the exchanged or carryover basis, which is the adjusted basis of your relinquished property. And then you have the excess basis, and that's any cash or equity on top of your original asset that you're rolling into the new property. The thing to keep in mind here is that the exchanged or carryover basis under the standard regulations is not eligible for cost seg. You would continue depreciating it until its existing life and method run out. And the excess basis is eligible for cost seg. It is eligible for bonus depreciation. And it is treated as newly placed in service maker's property on the date of your acquisition. The second big question we typically get is, hey, if we do a cost segregation on this 1031 property on either the front side or after it's acquired, is that going to cause my 1031 to fail, right? So if you think back, there's some standard rules. It's 15% personal property. You can't exceed that. But the biggest thing to keep in mind is that the definitions of personal property for 1031 and cost segregation are not the same. So if you think back to the slide that John used with that big flow chart of all the things we identify in the study as short life personal property, the 1031 does not consider that personal property. The 1031 limits the personal property mostly to the movable items, which is going to be your FF&E. This is just the examples, right? So these are what the 1031 regs consider structural components. And those highlighted items there, wiring, plumbing, pipes and duct, the flooring, security system, the humidity controls. Those are all things that we would identify in a cost segregation study as personal property, but for 1031 purposes, they don't count. So again, this is a just another play on that chart that John was showing. If you look back, we start on the left side with all the building assets from the GC. Those are further broken down into their construction divisions. The third column there breaks them out into their various components, and then they flow over to ultimately what their lives are. So if you look at that third column, you'll see that you end up with about 45% into shorter life between land improvement and personal property at the end of a cost segregation study. And that's going to pick up all your dedicated plumbing, your dedicated HVAC. That's going to pick up the kitchen piping, the carpeting, any flooring you have in there, as well as any kitchen equipment and stuff like that. And again, that's all short life asset for a cost segregation study. And then that fourth column there is, how it flows for the purposes of a 1031. And again, you're not going to pick up that flooring. You're not going to pick up any of that dedicated HVAC. That's all considered, 1250 property for the purposes of 1031. And again, there is a safe harbor for personal property on an exchange. It's 15% of the fair market value. And as long as you do not exceed that, your 1031 works. And again, so there isn't really a risk, for the majority of properties in doing a 1031, either, on the front side on a property that you say, hey, maybe down the line, I will do a 1031 on this. Where we would do a cost segregation study, identify the various assets, but we would, there's rare cases where it may exceed that 15%, but I'd say in 95% of the cases, you're never going to exceed that 15% of the fair market value. So you still are eligible, to 1031 a property. And again, on the flip side, on your new property, the same thing, right? There's really no risk in doing the cost seg in terms of, making you fail a future 1031 with those assets. So the standard 1031 regs do not allow you to touch the adjusted basis of your relinquished property. There is a subsection of 168-I, it's 6I, that allows you to make what we call the 1031 reset election. The 1031 reset election allows you to assign a new placed in service date and life and method of the newly acquired property to the existing basis. That basis is still ineligible for bonus depreciation, but you are able to assign, the new life and method of the new property to that bucket of basis. So we see this a lot where, you may not have had a cost segregation done on your original asset. So you have that all sitting in either 39 year, 27 and a half year on your existing depreciation schedule. And you want to get a cost seg done on the new asset, the new building, and you are able to, reset that life method and depreciation rate for the carryover basis if you make this election. It's pretty simple. I'm sure some of you guys have clients where you're making an opt-out of bonus. It's the same type of thing. You just attach a statement to the return and say, hey, I'm making the election under I-6I, and then you are allowed to, again, you place the carryover. Technically, you dispose of the asset on the existing depreciation schedule, and then, on the new acquisition date, the new place in service date, you put that portion in, and you would apply the results of the cost seg at that time. And another frequent one we have is what happens to the existing land, right? So you either have, a land only asset, right? Just a portion of land undeveloped, and you want to 1031 that, or just the land, on a standard, building lot, right? You have that split between the land and the building. For the purposes of a cost seg, that land adjusted basis, that is going to flow through as excess basis. And that's because you did not have a prior depreciable interest, right? Think back to that question we just did, the third polling question there. Land is not depreciable. And to meet the bonus test, you cannot have had a prior depreciable interest in an asset. And again, you do not have a prior depreciable interest in that land bucket. So when you're running that 1031 calc to get your new basis, that land portion of the original asset, again, whether that's a raw undeveloped, plot of land, or just, the split on your building, that's all going to flow in as excess basis. And we're at polling question number 4. So bring Ann back on.
Hi there. Thank you, Marty. This is our final poll. What do you recommend to your clients? A, cost segregation studies. B, 1031 like-kind exchanges. C, both. D, neither. Or E, not applicable. Again, this is our 4th of 4. You do need to respond to 3 of 4 and attend for 50 minutes in order to be eligible. And so far, it appears that most of our audience says that they recommend both. Some say not at all, none, or not applicable, rather. And then it's evenly distributed between cost segregation studies and 1031 like-kind exchanges. So with that, we do have several questions. I'll leave that poll open, and I will read the questions as long as we have time. First one is for you, Rudy. Can you elaborate on the disqualification of a flipper or developer for utilizing a 1031 exchange?
Sorry, I was turned off there. Yes, in the eyes of the IRS, a flipper or a developer does not hold property for investment or business purposes. And I know that sounds odd and contrarian, but a flipper, the way he or she reports on their filings, they do it strictly for profit, not for long-term investment.
Okay. At what price point do you recommend considering a cost seg on a single family rental home? At what price point?
Yeah, so the single family homes are the exception. We usually say 500,000, but if you were talking about like a regular house or Airbnb, 250,000 depreciable is usually about where we can make that make sense.
And just to add on to that one, that brings in more whether your owner can qualify as a real estate professional. That changed that answer a little bit too, right? Just in terms of what you're able to deduct versus your passive income. So that plays a factor on that as well.
Thank you. Is the 180-day rule extended if a declared disaster occurs around the 180th day timeline?
Yes, and every disaster stands on its own 2 feet, and we always publish disaster bulletins and the changes in IRS rules and guidelines, but most disasters do qualify for some sort of an extension.
Natalie asked, does a 1245 property qualify for a 1031 exchange?
So it depends, right? So there's different definitions for 1031, 1245 property and cost seg 1245 property. The majority of that property will qualify for 1031. And again, if it doesn't qualify, so you say you had a ton of FF&E, ton of equipment in a specific building, and you were to 1031 it, you're still you just recognize the boot on that. So again, you pull that bucket out, you will pay tax on it, but it's unencumbered for the 1031. It's not factored down for the gain, and you are able to depreciate it again. So it's not as good if you're generating boot, but again, you're still able to pick that up on the other side, and it's bonus eligible. So there's a little get back there if it it's considered boot and outside the exchange.
Thank you. We're revisiting the PIN or partnership installment note used when a real estate partnership sells a property, but some partners want cash and others a 1031 exchange. Partnership sells, buyer pays using cash and the PIN. Cash goes to the QI to buy replacement property. Installment note goes to the departing partner who pays cap gains on their payments from the note over time. That's a lot.
I'll be honest with you. I think I'd take that one offline. That is a question that I certainly cannot provide accounting or legal advice on. As you can see in the conversation, I entered information on the PIN. Partnerships are generally not qualified as 1031 exchange, and so you've got to be very careful when it comes to a partnership. They are not a part of the 1031 process. And I am certainly not a subject matter expert when it comes to the partnership. So I would recommend whoever's asking that, if you'd like me to dig deeper, and I'll dig with my legal team to take that offline. I also noticed a couple other questions I'll very quickly address. Is Brandon asked, what if I'm developing land and intend to construct rental properties? Then Brandon, in that case, you are holding the land and developing the land and constructing rental properties for investment purposes. So most likely that would qualify for a 1031 exchange. And Michelle asks, if a client wanted to invest 1031 proceeds into a DST, how do you facilitate that transaction? We facilitate that just like any other transaction. If the replacement property is a Delaware statutory trust or it is a physical piece of real estate, we still do all of the appropriate timelines, identification, holding of the funds, creating the escrow accounts. 15% of all of our deals go into DSTs today. And then Joe also asked, you need to recapture the depreciation when completing a 1031. I don't have a good answer for that because, again, I'm not a CPA. I don't believe you have to, but I guess I would question why wouldn't you want to? So that may be another one we could help offline. In the chat, I put a little note. One of the unique aspects about 1031 specialists is that we did build over many, many years a QI that has 100 years of 1031 exchange history from the IRS. Feel free to jump on that AI. You'll be surprised of what the questions and answers that you'll get. It's a great resource if you have a question on the fly.
Great. I think that is the remainder of our questions. I will get, Marcia, I will get your information to Rudy so you can have a deeper conversation. Thank you for joining us today. And again, if you do qualify for CPE, you will receive your certificates via email within the next 3 business days. Thank you for joining us. Take care.
Thank you.